The market's crashed, then the market's pumped, and we're blaming centralized exchanges and market makers. Don't understand? Let me show you how this works. Craziness in the markets. Who is to blame? Is it Trump? Is it the centralized exchanges? Is it the market makers? We can say it's a mix of all three. An understanding of what happened that might help you in the markets, or at least help you be more confident navigating them. Some of this information ends up being a good argument for why there should be more strength behind decentralized exchanges and why Coinbase is pushing to allow more decentralized exchange trading and action integrated into their centralized exchange apps. For purposes of education, I created this simple visualization that can help explain some of these things. First, we're going to start with what a market maker is. A market maker is meant to be able to provide orders that can be purchased and then orders that can be sold into, making it so that no matter where the market is, you can click the buy and sell button and have somebody to buy from or somebody to sell through. There's a typical order book in which there is sell orders sitting above where the market currently is, and then there's buy orders sitting below. The market makers are responsible on a centralized exchange to put these there. On a decentralized exchange, it's just a pool balancing, and it is always there, managed by the contract, not by market makers or exchanges. So there's always orders above that you can buy from and orders below that you can sell to. A market maker's main point of profit is their ability to buy and sell tokens for small price differences continuously all day, every day. They get reduced, if not eliminated, fees, which allow for consumers to have order books, to buy tokens, to sell tokens at any time. Now, they profit from this in that the tokens that are available for purchasing cost a little bit more than the tokens that are available that they're willing to buy for a lower price. This is called the spread. If a token is worth $1, they're available for purchase for 1.01 and they're available for being sold for 99 cents. So one person might be buying them for 1.01 while another person is selling them for 0.99, creating profit for any market makers involved. That being said, is that they're often blamed, and I've seen it happen, in that they will thin or thicken the order books on one side to get price to move in the direction that they want. And on some levels, this is reasonable. If they are not finding appropriate buy pressure at a level, it's somewhat reasonable for them to allow the market to sink down to a place in which people are willing to buy, creating a dynamic market in which is fun to trade and efficient. So but I've created this app in which we can go over several different buy and sell scenarios. The first being a completely balanced order book where one market buy will move the chart the same amount as a market sell. As you can see here, the chart moves rather reliably up and down based on the order book being balanced and even. Now, in times of high impact news, you might think, holy crap, that was a lot of buys or a lot of sells because the chart moved a significant amount. You are wrong. The volume itself might actually be low, but what the market makers did is they thinned their order books out. So now one simple buy moves the chart 4 times more than it did when the order book was thicker. Same thing with the sells, which is where you get some of that increased volatility that you'll see during high news events. Now we can look at a bearish example in which we have a market maker working on a centralized exchange who had thinned the order books to the downside. And if they do that, you can see that they themselves are capable of moving the chart in the desired direction that they want to, or at least influencing that through the order books. Here you can see with a thinned out order book to the downside, one buy might move us half a unit up, but one sell moves us down 2. It's because there's less orders available to sell into, making a simple single transaction move the chart down more than it moves it up. And I've seen this in different scenarios. We can push it a little bit further to an ultra bearish scenario in which the sell side order book is even thinner, in that a single sell moves the chart down 4 units, while a single buy moves the chart up 1 unit. And you can see this in various different heat maps. Let me pull up an example of one. Here you can see a heat map that people use in this cloud cluster of orders surrounding the chart. To the top and downside is the market makers buy and sell orders. And I've seen it before. As the market makers orders all had dissipated or disappeared from the top of the chart. And sure enough, the chart ended up continuing up, because for even the smallest buys, we ended up moving a lot to the upside. Now that is important. When there's thin order books, the chart is easier to move. Back to our example app, we can go to an ultra bullish example where all the sell orders have been removed from the top side of the chart, and a single 100 unit market buy moves us up 4 points, where it would take a total of 400 market sells to move us back down that same amount. So this is how market makers are capable of influencing the up and down direction of the chart, by thinning or thickening the order books on one side or another. And we must remember is that the market maker, yes, they're obligated to provide liquidity, but their main priority as a business is to make money. They are meant to be as profitable as possible. Now, things get a little bit more complicated when we start adding the fact that there are people trading on these markets with leverage and with stop losses and limit orders and things of the like. Here you can see an example where we have someone who had a long order with a liquidation price right down here above $98. If the market decides to sell down to that level, that liquidation causes the automation of a sell order exiting that trader, which pushes the market down even further. This can be compounded by what's called a cascade event, similar to what we had seen over the weekend, in which a single liquidation can push into other liquidations, triggering a cascade of sell orders, which pushes the market down exponentially further. Now, if the market makers, such as what is said to have had happened this weekend, have thin order books, having known that things were going to go wrong, they just wanted to have as little exposure as possible, a thin order book cascade has even more substantial consequences. So that is what I'm hearing, is that the market makers and centralized exchanges thinned their order books, and the cascade event of all the longs created this historic market crash in which longs were liquidated, and it didn't take a lot of sell pressure to cause that liquidation. You can see with thick order books, the market doesn't move much. Generally speaking, this is how market makers have control over the charts, by thinning or thickening the order book in the areas in which they want to protect on the chart. The same thing can happen in the other direction, where you can get a short squeeze, as they call it, where there is a liquidation cascade event to the upside. Again, thinner order books will amplify this significantly. It can happen to both sides. That being said, as you see it happen to the downside more often, people are more likely to be using leverage on longs, even small leverage in a bull run, hoping that their 2x leverage long doubled their buying power and was going to lead them to financial freedom in the bull run, all of which are now liquidated. So who is to blame? The market makers, the centralized exchanges? I will say I think that they are both to blame. That being said, is we do have decentralized exchanges, we do have DEXs. If you're familiar with the project in which that I work on, Beats on Base is not listed on any centralized exchanges by design, purposefully, because I do not like them. I am not a fan. Having thick full liquidity on a decentralized exchange protects you from this, and it cannot be manipulated by market makers and centralized exchanges. That is all. I hope that this helped. Till next time.